And I'd like to welcome the bond man himself, Jim Grant of Jim Grant's Interest Rate Observer. So, Jim, I can't think of a more appropriate person to have on a day where after quarters and quarters and quarters of accumulating high leverage debt, triple B debt, having the Fed and central banks have rates low enough that any form of debt and yield look good, covenant light, and now all of a sudden we open the exit doors. What do you see going on? Describe how the liquidity is, what the Fed's done, your thoughts.
Well, liquidity is this thing that is there when you don't actually need it, and it's certainly not there when you do need it. The Fed seems to be at sixes and sevens, not knowing quite what to do except to do more of it. But I see something circular in all this, Rick. To meet a crisis, our central banks, the governments, foster credit formation by suppressing interest rates, doing QE, but that increment of debt impairs, as it's, so to speak, because we're all epidemiologists now, it impairs the corporate immune system. So the next time there is an actual business cycle problem, businesses are weaker than they might otherwise be thanks to the medicine that was so liberally dispensed to them to meet the crisis. And so we come to the present day. There is more debt than ever before in corporate debt as a percentage of GDP, and the quality of that debt is weaker than it has been, at least since 2007. And to meet this difficulty, governments the world over are borrowing more, and central banks the world over are intervening more, printing more, and suppressing more. One does wonder where it ends.
Now, with regard to where it ends, next week we're going to have a Fed meeting. Now, we've seen Christine Lagarde, for the most part, hold pat. I was very impressed. We've seen Carney and the Bank of England be a little more aggressive. We somewhat expected that post-Brexit. Your thoughts? There's calls out there that they should go to 0 to 25 again. What do you think, especially under the terms of $1.5 trillion liquidity thrown at the gears?
Yeah. Well, I think the Fed will act and try to do something aggressive, perhaps zero again. I want to commend Christine Lagarde on her first statement before she was reminded that it was not going to pass muster. What she said was, we are not here to manipulate or to do something with credit spreads. And she had to walk that back because the Central Bank of Europe, the European Central Bank, is indeed there to manipulate credit spreads. So I think it's important that central banks, whatever they do, at least don't forget that interest rates are prices, and these prices mean something. And I think not a little of our difficulty now is that the prices have been skewed and manipulated and distorted such that debt is much more abundant and much lower quality than it would otherwise have been, except for the central bank's exertions.
Well, in the final minute we have, here's my big problem, Jim, is that we need to make sure the average person, small businesses, don't get tsunamied by the economic repercussions of what may yet come. But on the other hand, many of these entities that are going to be getting help just love leverage, and probably instead of trying to deleverage, they're going to take any type of help or liquidity given them and re-leverage. How can we keep that from happening again, but still address the issues we need to today?
Well, Rick, I think we need a different race of human being for that one. I think people respond to incentives, and the incentives have been and remain, for some part, to borrow more and to lever more. Although, at the margin, there is a wave of deleveraging, so it's rather mixed. But we'll know more in 10 years, I say, Rick.
I got you. Well, listen, Jim Grant, thank you. Nobody knows the future, but nobody knows about bonds in the present better than you do.